Well, good morning, everyone, and welcome to our ADU Wealth Mastery. And today is kind of a cool topic. We're going to be talking about tax strategies. There are identifiably, there are a little over a total of 40 tax strategies for federal taxes. We've identified the more popular 28 that are going to be pretty common. And I'll just say at the outset that a lot of that will be subject to change now that the tax legislation bill that was passed this last week out of the House and signed yesterday by the president. All of these tax laws are changed retroactive going back to January 20th when the president was sworn in. That's going to have a very big impact on the real estate industry at large. And more specifically, it's going to have a dramatic impact on ADUs. The tax legislation is pretty sweeping. I have not seen, except for the Tax Reform Act of 1986 and the Tax Reconciliation Act of 1987, we haven't seen a major piece of legislation that has that much impact. So it's going to be a big deal. We'll be putting some stuff out over the next couple of weeks. Everybody's going to be affected by this. There's nobody that will not be affected by this tax legislation. So today we're going to focus on these more popular 28 tax strategies to give us sort of a foundation. Like anything in life and anything in business, the ability to navigate financial transactions is only enhanced by the ability to plan. In other words, no planning equals very little or no benefit. Planning generally can be translated and measured into the direct benefit. And so tax strategies are a very significant part of any financial plan or retirement plan or any other kind of financial plan. So we'll dig into that today and cover these 28 primary strategies. And again, this is all at the federal level because every state, to the extent that there are state taxes, especially those affecting real estate investments, they're going to vary from state to state, but they're all predicated based on what the federal law does. This will also be translated into the impact of these strategies as it relates to a buyer, a seller, an investor, or an owner of a property that has an ADU. You could have a client that owns a property that has an ADU right now, and they may want to build another ADU. They may want to sell the ADU. They may want to do something different. So all of these different scenarios give us an opportunity to look at the same situation from different perspectives. Tax strategies are really about strategic positioning. And again, the success formula is sooner rather than later. Waiting to develop a tax strategy is very expensive in the sense that there's very few things that you can do from the tax standpoint retroactive and go back in time and take any benefit. So it's really important to have an understanding, just like in business or any other situation, whatever you're getting ready to do, make sure that you have vetted that decision through the process or the impact of what the tax impacts are going to be. It's one of the biggest things that erode wealth. So whether you're buying, selling, building, converting, The tax code can be a wealth of opportunity and reward, or it can be a jealous master that will take most of your wealth when you're paying the tax that you otherwise wouldn't have to pay. Basically, a tax strategy is a plan that's designed to minimize any tax liability, in this case, federal tax liability, while complying with all the applicable tax laws. What we're trying to do here is we're trying to optimize our financial decisions in a way that those decisions take into account the exposure that we have to federal taxes and reduce that amount that we would otherwise owe or have to pay. We look at after-tax income because that's a calculation that tells us the efficiency ratio of tax planning. And if you have no planning, then you're going to have a very low efficiency ratio in terms of your tax impacts. We want to do that because we want to take advantage of all of the incentives. And right now, with the passage of this new law, there is a whole basket of goodies that are going to be available. Some key components of tax strategies deal with income deferral, tax deductions and credits. These could be credits or refund credits, tax efficient investments like retirement, HSA, those kinds of things, municipal bonds. How you structure your business affairs or how you structure your rental activity. Are you doing it through an entity? What kind of entity? There's 6 different ways that you can set up a structure with an entity or a combination of entities for your ADU. And that's really going to depend upon what your game plan for the ADU is. That's going to decide its business structure. Capital gains management, estate and gift tax planning. If you have an ADU and you haven't updated your trust, you have a probate issue that you should meet with your trust attorney and fix because it's going to be treated as a separate asset class, and you could have some other issues that you're not even aware of. We also look at offshore and state tax optimization. There are some opportunities for more sophisticated planning in those areas. The most important first tier of benefits from a good tax strategy is it lowers your tax burden, both now and in the months and years ahead. By lowering the tax burden, it improves cash flow, gives you the confidence of compliance, and gives you the opportunity to integrate long-term wealth preservation. Long-term wealth preservation is different than long-term wealth accumulation. You can accumulate the wealth, but you've got to do something to preserve it, and you've got to do something to protect it. And so these are complementary in the sense that every tax strategy has built into it a wealth protection and wealth preservation component. Who needs a tax strategy? Basically, anybody that files tax and pays taxes could use and benefit from a tax strategy. So whether you're an individual, a business owner, an investor, retiree, families with estate planning needs, everybody can probably benefit on some level from a tax strategy. Well-structured tax strategies are compiled into a tax plan. A tax plan has different components that include not only the tax strategies, but compliance and exit strategies. If you have an investment portfolio of 5 pieces of real estate, what's your exit strategy on each of those pieces of real estate? If you don't have one, I can tell you you're going to pay the most in federal taxes that you could ever possibly pay because you're going to have the most exposure with no plan. You're going to have capital gains. You're going to have the recapture of depreciation that will be taxed at the ordinary income level. You're going to have threshold phase-out rules where deductions are phased out. You don't get any because of certain AGI limits. All of these things go into the composition of a plan that allows you to develop the strategies that allow you to mitigate, reduce, and otherwise nullify the effect of the tax impacts on your ability to accumulate and preserve wealth. Well-structured strategies, at a minimum, should be reviewed annually. Most of the clients that we work with, we do that at least twice a year. And then if we have legislative changes, there's another third time that we do the legislative changes, usually around October, just to make sure that we don't have any loose threads. So today we'll focus a little bit more on the 28 tax strategies that affect ADUs, targeting, again, buyers, sellers, investors, and owners. I've broken this down so that we can look at these in terms of each group: buyer, seller, investor, owner, and each group having 7 strategies that directly affect them. These affect buyers more than they affect sellers. That's kind of the approach that we're taking here. There should be a sense of urgency to do a review, and there should be a sense of urgency to at least understand, particularly in light of this new legislation, because there won't be anybody in the country that files a tax return that will not be affected by this new legislation. So we start with the buyer's analysis. Somebody's going to buy a property that has an ADU. And this is an acquisition foundation analysis. This allows us to take the buyer, look at their financial circumstance, look at the property, and then create a pro forma that not only indexes each of these 7 strategies, but allows us to then extrapolate that result and do modeling so we can tell the buyer, in most cases that are buying a property that has an ADU, within 60 months of you owning the ADU, the portion of the purchase price that goes to the ADU, if you implement these tax strategies, will save you about 60% of the cost of the ADU, and your mortgage for living in the house that's on the property will probably be 50% less than you would otherwise pay. In other words, you pay $800,000 for the property, and in the course of 5 years, you're probably going to save $250,000 to $300,000 in tax, federal tax, if you implement these strategies and take advantage of them. We do basis allocation strategy because that's going to give us the biggest driver. How we take the basis that you're paying for the property and we allocate that so that we can implement 5 to 8 different strategies just on that one determination. That takes us into looking at cost segregation, an advanced level of cost segregation. That lets us look at other opportunities like an MCC entity strategy, which is a management corporation conduit that allows us to do some more advanced planning for long term. It allows us to identify those CapEx expenses that need to be capitalized and added to the basis. It lets us maximize first-year operating loss position. If we harvest those tax benefits, we can create a financial tax loss, not an economic loss, but a tax loss by better positioning those strategies. And then we look at mixed use planning between the buyer's rental use intent and other things that would be available that would give us some additional tax savings. So this buyer's analysis is a pretty sophisticated exercise. It allows us to show the buyer, you're paying $800,000 for the property. And over the course of the first 5 years, you're going to save $250,000 in tax. So you take your 800,000 minus 250, that's your real cost of the property. And then you take that 250 and divide it by the 800, that's your internal rate of return just on the tax side of the equation. It's a pretty significant result. And it's something that almost nobody does. I'm not sure why they don't, other than probably a lot of tax preparers don't know how to do it. If you're selling a property that has an ADU, then as a seller, you're going to want to do a gains analysis and seller's transaction analysis, because that's going to tell you, if you do no planning and you sell, how much of the money that you get from the sale you're going to be able to keep. It's also going to tell you how much of the money that you'll be able to keep will increase if you do a couple of things before you close escrow. And so we look at all of those opportunities through the lens of what is possible, so that we can reduce income tax and we can reduce recapture tax, capital gains tax, all of the federal taxes that you're going to be affected by. It gives us the lens to look through and identify. We'll look at different strategies, from installment sale to sell or carry, deferral gain reporting, Section 121, which is the $500,000 exclusion, versus Section 1250 planning. That's splitting gain exposure that can sometimes result in reducing your capital gains by as much as 50%. Qualified opportunity zone roll-in strategies, 1031 exchange carve-out strategies, depreciation recapture shielding, sale leaseback for income continuity. All of these strategies give us an opportunity to maximize the amount of money that the seller is going to be able to keep on the sale and disposition of the asset. And it's an extremely valuable analysis. If you're an investor, we're looking at growth and leverage optimization, but we're looking at an investor's analysis because we're looking at IRR, the internal rate of return, the ROI, all of those components. We're looking at how did the asset perform as an investor when you bought it, how did it perform when you held it, and how did it perform when you dispose of it. Those three periods of analysis and the holding period are going to be major factors that are going to decide how much of your money you're going to be able to keep that will not be unnecessarily taxed to oblivion. We look at entity stock structure because it may be, it's not an asset sale. Maybe we do a stock sale. And we hold it a certain way because we get some extra tax benefits by having a corporate LLC structure. We look at short-term rental under the 14-day rule. And then we look at the 280A exemptions. We're doing passive loss strategy, real estate professional status, all of these different rules that affect an investor decide how much of the money during the holding period and the period of disposition, how much of that money the investor is going to be able to hold on to and keep without having to pay tax unnecessarily. Almost every investor that has or has held an ADU rental for 3 to 5 years or more pays at least $75,000 to $100,000 more in tax than they have to. It's just crazy the amount of taxes that they could save that they just have no clue. If you're an owner and you already have an ADU and you're thinking about moving out of the house and converting the house, you're thinking about adding another ADU, you're thinking about selling, whatever it is that you're the owner of a property that has an ADU, we're looking at different aspects of strategies that you're probably not aware of that will allow you to maximize both now and in the years and months ahead the amount of money that you're keeping, depending on how you set up the ADU and its character. We look at the rent segmentation. That is a big deal. Most ADU owners are charging rents between 20 to 30% below market. They don't even realize that. We look at the opportunity to take advantage of a home office. We look at the homestead versus rental designation, rotation, depreciation, and all of those types of strategies. We look at partial cost recovery on improvements. We look at strategies involving lease to family structure, gift and tax planning, basis step up on inheritance, estate, probate, annual audit proof documentation protocols. All of these come into a report. Most of these reports are between 70 to 100 pages because they're very in depth and very detailed. All of these guides are available in the back office for half the price that we sell them for on Amazon. So I would suggest don't buy them on Amazon, buy them in the back office. Then we get into the area of just basically what do we do with the information? And then how do we take that information, compile it, digest it, and develop an action plan? And that's really where the rubber meets the road, is once we've identified everything, how do we make it work? And so every strategy, it's important to understand the later that you wait into the year, I can do a lot of stuff if you start the plan in January. I can do very little, if anything, if you start the plan in December. Almost nothing I can do in December. So the sooner, the better in terms of starting the planning process. IRS doesn't care. They don't care about me. They don't care about you. They don't care about anything. All they want is the tax return and the money if you owe. So it's really important to understand that being proactive and engaged in the planning process, tax strategies are not gimmicks. They're not loopholes. There's no such thing as a loophole. All a loophole is a strategy somebody taught you about and how to use it. They're not tricks. They're not gimmicks. As enrolled agents, admitted to practice before the IRS, we're not allowed to give advice that's not accurate. We had to take 3 examinations to be admitted to practice, go through a whole bunch of stuff that we have to do every year just to keep that intact. And when it comes to tax planning and tax strategies and implementation of these things, it takes a great deal of focus and experience and effort to be able to sit down and say, look, in the next 5 years, you have an opportunity to save $250,000 to $300,000 in tax. If you do nothing, your upside is going to be a downside because it's going to cost you an extra $250,000 to $300,000 in tax. Very little that you can do in planning where you can actually measure that result before it happens. And so that's one of the things that give tax planning and tax strategies huge advantage over financial planning. But tax planning is part of financial planning. If you wait till you're audited, it's a little bit too late because then you're on the defense, not on the offense. So you want to be able to control the narrative and the outcome to some extent by having a plan already in place. The pro forma analysis, that would be something that we do for no matter what the status of the client is as a buyer, an investor, a seller, or an owner. Pro forma just measures the financial economic performance of the asset. ADUs are a new separate asset group. When you have an ADU on a single family property that was your primary residence, you have forever changed the tax character of your property. It's no longer a principal primary residence. It's got a hybrid mixed use, and depending on what you're using the ADU for the production of income as a rental property, that's its character. You're going to be affected significantly by the taxes, whether you want to or not. So if that's true, and it is, let's do it in a way that we get some big advantages. The types of strategies are going to vary widely depending on if you're an owner, a buyer, a seller, an investor, and depending on how you're holding the property and disposition, all of those things. But the good news is that once we identify what the issue is, the ADU, and once we identify what the need is, figure out all of our tax strategies, it's not that complicated to go to work and figure out what is available to any client that they're going to be able to do. And then how do you go about implementing these various strategies? What we often find is there's also additional hidden opportunities that reveal themselves because we learn more about other decisions that the client's going to be making that will actually have a direct or indirect impact on the plan and how we use the strategies. I'm going to go through a handful of these on the front end just to give you some idea. And the purpose here is to just give you a little bit more of an idea how we frame looking at a tax strategy and how we frame its use when we apply it to a specific situation. The answer to every tax question is it depends. The answer to every tax question is it depends. And I don't mean the diaper. It depends on your facts and circumstances whether you can do this like your friend John and Mary did. Just because John and Mary did it doesn't mean you can do it, or doesn't mean you can do it in the same way. It's going to depend on facts and circumstances surrounding you, your position, your tax pro forma, and your ADU. It will depend. It doesn't take a rocket scientist to figure out how that works, but until that part's done, nobody in their right mind would give an answer to a tax question without having more information available, because it's going to depend on a lot of facts and circumstances. Basically, you take the asset, the ADU, the acquisition, the cost, that's the basis of the main home, and that of the ADU structure, and you segregate those two for purposes of determining your inside and outside basis and determining the allocation of the asset with regard to how depreciation is going to work, how you're going to track improvements, how you're going to track repairs. All of this has to be decided, or the default rules that you'll be forced to use are going to be very expensive. At the time of purchase or during any property upgrade, we're going to set up and look at a reasonable portion of the property's cost being allocated to the ADU based on either the valuation, the appraisal, the actual construction records, whatever it is. And we're going to set up a formula that's required under the tax rules to allocate both the common areas and the non-common areas, because that's another tax trap that if you don't address that, you're going to overpay taxes when at some point in the future when you sell it. Depreciation has to be recaptured and put it back on your tax return and tax it as profit, whether you claim the depreciation or not. You have a lot of control in the amount and how you claim that, depending on the gain. And so this is a perfect example of a great opportunity how to significantly reduce future tax exposure by the kind of planning that you do today. It's tens of thousands of dollars in savings. So buyers who acquire a property with an existing ADU or people that are converting part of their property to build or have an ADU. These are people that are going to have a significant benefit in deciding how they're going to do those allocations and how they're going to take advantage of these rules. Cost segregation on the purchase and then any improvements thereafter give us opportunities to maximize not only the depreciation deduction, but minimize the amount of recapture exposure. So we get benefit today and we get benefit in the years future on some future disposition and sale of the property, how to reduce the tax exposure when you sell. The common area, the driveways, the sidewalks, the yard, all of those things, if you took the total square footage of the house and you took the total square footage of the ADU and you add them together and you say, okay, well, the ADU is 25% of the total square foot and the house is 75% of the total square foot, then the ADU would get an attribution allocation of all of the depreciation for all of the improvements that are on the land that are not buildings. Your trees, your shrubs, your fence, your irrigation, your sprinklers, your sidewalks, your driveways, all of those things become depreciable assets. And the ADU gets to claim, in this example, 25% of those. The ADU gets to claim 25% of the insurance, 25% of the property tax, 25%. It's a big deal under the attribution rules because it's one of the areas that every ADU owner misses or gets incorrect. And I'm not sure why, other than they've got a tax preparer and not a tax advisor that basically doesn't know what these rules are. What cost segregation does is it allows us to segregate the asset into different property classes based on class life and allows us to maximize the tax attribution rules and the tax attributes and the financial attributes of those assets as they're segregated into asset groups. It's a very, very, very sophisticated result that gives the benefit is you save a boatload of money, both now and in the years ahead. The FHA 203K loan is a loan that allows a buyer to include the ADU construction or rehab into their mortgage. We'll probably do a workshop or webinar with a lender that talks about some of these unique features of loans that allow a buyer to take advantage of these things. But there's some great opportunities in this situation to do some really cool tax planning and tax strategies. A buyer using an MCC structure is a management corporation conduit or a management conduit corporation. The LLC is the operating holding arm of that transaction with regard to the ADU, and then the corporation is a managing member of the LLC that creates a conduit under a management structure, and it allows you to collect that rent. And probably for the first 5, maybe 6 years, you won't have any taxable income in how you do that because of this particular structure. It allows you to take advantage of some very, 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 very cool planning opportunities with the corporate structure, but also because the LLC is going to be taxed as a partnership, it allows us to take some advantages there as well. We've used that structure. My wife and I continue to use that structure, and we've got clients all over the country that are using that structure. It's very effective, very powerful. Capitalizing the closing cost. Not every cost is an expense deduction. Every cost looks to how much do you have that you can deduct, or how much do you have to add to capitalize that expense and amortize it over a period of time. It works like depreciation. So escrow statements are very important records, because we go down that list of the items that were allocated and we classify. And this is where we find a lot of mistakes. And usually they cost the owner in extra taxes. First year operating loss positioning. Basically, we're going to generate a tax loss, not a financial loss. We're going to maximize depreciation, management fees. We're going to maximize all of the tax attributes and the financial attributes in a way that we will be assured for the first 4 to 5 years, we're probably going to have a tax loss. Those losses, depending on whether they're passive or active, are going to be able to offset other income. If it's a passive loss, 100,000, and you have $100,000 of passive income from the sale of stock, you now have no taxable income because one offsets the other. If it's an ordinary loss and it's 100,000 and you have $100,000 in wages, you have no taxable wages because it offsets ordinary income. This kind of planning is critical because this really is where you either keep the money or you pay the money. And you don't want to complete the transaction and close out the year and find out that you missed $100,000. 280A, Section 280A, which is a mixed use planning, is a strategy that allows us to take that section of the Internal Revenue Code and look at the facts and the circumstance to this particular client and use something called a buyer's rental use intent analysis, because it gives the buyer some additional decisions that they can make in that first year that could give them a significant tax benefit in that first year. And so we want to look at that and do that analysis, because it could give us, in some cases, it could give us as much as 30% of the cost of the ADU in the first year. If you don't document certain things and you don't have the record keeping in regard to these things like rental intent, that's one of the things, you could lose the benefit or the tax attribute or even lose the deduction. So it's real important. This comes under the realm of compliance. It's really important that you want to be in compliance, but also you want to be in compliant in a way where you're not missing a lot of stuff that could give you a lot of tax benefits. Installment sale with an ADU segmented out is a different way under Section 453 that allows the seller to report the gain over time. Let's say you do an installment sale. It's a 10-year note, all due and payable on the maturity at 10 years. And they make payments to you over time. You get to spread the gain portion over those 10 years, and it allows you to do other planning to offset those gains over those years, and gives you the chance under this particular strategy to segment that portion of the gain out where you could actually neutralize its tax effect with other strategies. Seller carried financing with deferred gain reporting works kind of the same way. Your gain is allocated proportionate to the percentage of gain over the period of time for the note that you're carrying, but it also gives you a little bit of an opportunity to convert lump sum gain into managed income, which also then allows you to reduce or lower taxable income spikes and even out those big. Back in the day, in the 80s, we had a rule where we could do 5 to 10 year income averaging. And that was kind of a technique that benefited a lot of taxpayers. Because if you got a big spike of income in one year, you could use a 5 year averaging rule. This kind of works the same way under the same principle. Um, the bottom line is it can save you a boatload of taxes if it's implemented correctly. Partial 121 and Section 1250 planning. Section 121 says that if you've lived in the property as your principal primary residence 3 out of 5 years, any 3 out of the last 5 years, any combination of 3 out of 5 years, and you're married, then the first $500,000 of gain is going to be tax-free. First 500,000 of gain is going to be tax-free. It's 250 if you're not married or single, 500,000 if you are married. Well, let's say you sell the house for $800,000, but 300,000 of that was the ADU. You can't use the 121 against the ADU because that was a rental. It's not a primary principal residence. Section 121 only applies to the portion that was allocated to the primary principal residence. Section 1250 gain is the gain that you're going to have that's attributed to the ADU under the tax attribution rules. And unless you've done any planning, all of that's going to be gain. So this is why we look at these strategies, even at the point in time when you buy the property and build the ADU, because you want to have a plan already in place 5 years from now that addresses this issue, or you're going to get squeezed and crushed in the tax bill that you're going to have to pay to the IRS. What the separation, this strategic separation does is it avoids this invalidation of the 121 exclusion portion and moves it to be applied under the Section 1250 guidelines and allows you to do a lot of planning to mitigate those capital gains. Qualified opportunity zone roll-in. That's going into a qualified opportunity zone. You're rolling into that from a transaction. You're selling the property. You're going to take a portion of the gain and you're going to roll it into a qualified opportunity zone and going to get a lot of tax goodies for doing that. Basically, it just says that you're going to reinvest the gain on the ADU portion into one of those zones within 180 days. It allows you to defer the taxes and eliminate any additional gains after 10 years. That's a big deal. That's a really big deal. And these things are very easy. They're managed funds, if you will. There's a lot of transparency. You can see how they work. It gives you another option that you may want to consider. You still have control of your money, but this is a tax play and purely a tax play, but it also, I think, has some components that makes pretty good sense from a financial position. The ADU to a 1031 tax deferred exchange, we call that a carve out because you're carving out the portion attributable to the ADU. Now in California, under a new assembly bill, I'll actually be doing a presentation to a couple of hundred real estate professionals this month. You're able to carve out your ADU and sell it as a separate asset. You can't do it if it's a junior ADU, but if it's just a normal regular ADU, you'll be able to sell that. And you're going to see this revolution in the real estate market radically transform the real estate industry over the next couple of years, forever changing how real estate is done. This is not going to be limited to California. I've been sounding the alarm on these opportunities for at least the last 7 years. And now the legislation is actually catching up with the reality. In 2016 in California, we were doing about an average, I'm going to say somewhere around 22 ADUs a day. By the time we get to 2028, it's going to be about 300 a day. Nationwide, it's going to be about 1,600 a day, about 400,000 a year. This thing with ADU is going to transform the real estate industry forever, changing it. And if you get in early enough and you can use a lot of these strategies, there's going to be a lot of people that are going to be very wealthy by the time we hit 2030. This is a very, very, very big deal. The last one that I want to cover a little bit in detail before I move to the next section is basically the depreciation recapture. Whether you claim it or not, you have to recapture it as allowed or allowable. So there's a strategy, it's called shielding. And what that means is we're going to shield through a strategy the impact of having to recapture depreciation so that we don't have to recapture it, or we don't have to recapture as much of it. We can use energy upgrades, we can use gifting technique. There's a lot of different things that we can use, but basically the depreciation that was allowed or allowable, that was claimed or whether it was not claimed, has to be recaptured at the sale of the property and taxed at 25%. If we do some strategic reinvestment, like a solar play, or like a cost segregation reallocation play, or a gifting play, there's some things that we can do. Now, remember that solar is going to run out pretty quick because that new legislation is getting rid of all of this crazy green energy stuff that was, if it weren't for the tax attributes, nobody would ever buy solar or invest in a windmill because it doesn't make any economic sense. So you're going to see a lot of these companies fold up because they're not going to get any more of those tax goodies. You buy an electric vehicle and you get a $7,500, $15,000 credit or whatever. You put an energy wall on your house and you get that credit. That's the only reason that those make sense. That's all going away very quick, very soon. So you have to think through the process of the impacts and then look to what is left that you're going to be able to use. This is a very important deal because otherwise you're going to have a big tax surprise because you have to add that depreciation back to your profit and tax it at 25%, whether you claim the depreciation or not. It's as allowed or allowable. Considerations in the selection of the entity for an ADU depends on a whole lot of facts and circumstances. But basically, we have developed, using a platform with AI as a component, we have developed an assessment tool that allows us to take information that the client provides and do an assessment. And in the results of that assessment, it will give us some recommendations and it will tell us the most tax and financially efficient structure that works for that client based on their facts and circumstances. We're actually going to be entering into some development agreements later this year to actually develop the software, the standalone cloud-based software package to cover all of this. But basically, we have our own software that we use for the different components, and we have an AI platform that we integrate with that. And over the last couple of years, I have written these command prompts that allow me to do this analysis in a way as if we already had the software. But I can tell you that the assessment results in this regard are significantly worth looking at because it gives you an opportunity to plan exactly every stage of the ownership cycle of the ADU through disposition and keep a significant amount of your money with using these entity structure and tax strategies as a component. As I indicated, at the federal level, there are actually over 40 distinct federal tax strategies. You got about half of them that are in this, and there's a little ebook that we've created that you can log in after today. You'll be able to log in, watch the video. You'll be able to download the ebook. It kind of puts it all together. I think the ebook's probably 45 or 50 pages. It goes through some detail to all of these things. Basically, what we're trying to do is build a bridge for a gap. The gap is like the distance between 2 points in the Grand Canyon. Let's say that gap's a mile wide. We need to build a bridge that extends over that gap, called a tax strategy, and a plan that bridges that gap so that you can keep more of your money, be in compliance, and not be unnecessarily exposed during the purchase, the holding period, or the disposition of the asset, being overexposed to any level of tax. And so this analysis and what we call pro forma analysis allows us to really look at the kind of bridge that we want to build. Income deduction and depreciation strategies. Also, all of this is changing because this new law was passed. You now get $40,000 a year that you can deduct in property taxes. Well, you don't have certain limits if it's a rental property, but how do you apportion that when the rental property is on your home property? So we look at the mortgage interest, depreciation, accelerated depreciation, cost segregation, all of these things, capital improvements, utilities, insurance, maintenance, all of these things have to go into that analysis as part of the pro forma so that you have an understanding of what you might be missing, because some of these are going to phase out after 2026, but some of those are going to stay in place because of this new tax bill. You'd want to know which one of those are going to stay in place. We're going to look at capital gain and exclusion strategies. How much of the gain can we exclude? There's a whole host of things that we can do there. We're going to look at the strategies in terms of rental versus business use, because those are two different uses. You get the business use when you set up an entity structure that allows your rental property to also not only be a rental property, but your activity regarding the rental property is that of a business. That opens up the qualified business income deduction under 199A. So 20% of your gross income and your management fee is not going to be subject to tax if you set it up the right way. Short-term rental under active participation is, you got short-term rental, STR type income. If the 7-day rule exception applies, you're probably not going to have very much taxable income. So these are things that you definitely would like to look at in terms of making sure that we're not overlooking some really powerful opportunities for you. Entity structuring and asset protection. ADU that's owned in an LLC for liability separation and possible tax advantages. Maybe you have a corporation that's going to be the management conduit. Maybe it makes an S election, or maybe we get a partnership treatment. Those are going to be governed again by your facts and circumstances. ADU is part of a business strategy before it's anything. It should be. And then we look at the type of series LLC structures for multiple ADUs. We've got some clients that are going to be, they're doing like a couple of dozen of these ADU deals. It's crazy. We're looking at credits, the residential clean energy credit, that's going to go bye-bye. Energy efficient home improvement credits, probably going to go bye-bye. This displacement, disproportion subsidy, if you will, for green energy at the cost of taxpayer dollars has got a short shelf life in front of it. By the end of the year, it probably is all going to be gone. That's going to change how things are done next year, because there are going to be new ways that the legislation is going to bring forward some of those things that are going to stay intact. Upgrading appliances, upgrading windows, doors, those things are probably going to be redone in a way that's going to be more favorable. Retirement and legacy planning. A lot of clients are using ADUs as part of their supplement to their retirement planning. There's some really cool strategies that you can do that can give you some pretty wild outcomes if you want to do your ADU under some of these self-directed rules. I'll just say that for right now is a separate analysis, but that's why you want to do this pro forma analysis. It's going to give you some opportunities to do some planning in ways that you probably didn't think about. Obviously, compliance and optimization is part of an ongoing process. And the basic way that we do it is once we set up the strategy and the plan, we help you monitor it. There's no additional cost for that, because we want to make sure that you don't miss it every year. If your strategy is a 3 to 5 year strategy, you want to make sure that you're taking advantage each year and maximizing that. So one of the features and benefits when we do this kind of analysis is we do that monitoring, and there's no additional cost for that, irregardless of who does your tax return. And if we're doing this modeling with regard to your ADU, we'll do all the tax reporting at no cost. We'll do all the tax forms, everything. There's no additional cost. That's kind of an advantage to having this in place. I'm going to say somewhere between 40, 45 federal strategies. There's probably 200 more, depending on what state you live in. There's dozens more variations that exist when you combine the ADU ownership with homestead exemption, your probate exemption, your business overlays, your inheritance planning, your property tax. All of these things go into the composition of creating your ADU pro forma. You want to know how, as an asset group, how is your ADU performing financially? And this is what a pro forma does, measures performance. We suggest a consultation to discuss the total game plan. Do that initial analysis, because that's free. That doesn't cost you anything. We'll put a couple of hours putting that together and then give you that summary report, somewhere between 40 to 60 pages, that will give you a pretty good roadmap with a list of recommendations that apply to you. They're not going to be the same for Bill and Mary. Bill and Mary have different facts and different circumstances and different children and different needs. This is the danger. Just because your neighbor, your friend, your brother-in-law did it doesn't mean that you can or should do it. Tax attributes are very personal. They're very unique to your facts and to your circumstances. And part of the challenge is that if you don't know what you don't know, you're already paying more than what you should. Talk a little bit about the combination of entity structuring. This is basic entity structuring 101. You have a choice amongst about 5, possibly 6 ways that you could structure with an entity to maximize financial performance and tax performance with the financial and tax attributes. You can do a single member LLC where you own all of the shares of the LLC. That LLC, for purposes of tax, is disregarded. It's a disregarded entity. It doesn't count for anything. The problem is how it's going to be taxed in terms of the character of the ADU. If the character of the ADU is that of a business, then it's going to be taxed for purposes of self-employment tax. if it's the intent that its character is that of production of income as a rental property, then it's going to be taxed as a rental property. It's going to be taxed differently. What you want to do is make sure that it's not being taxed in a way that is unfavorable to you. And single member LLCs generally are not very efficient because you can insure against potential loss with an insurance policy. You don't need an LLC for that purpose per se, but this is a conversation you should probably have with an attorney because you may have different facts and circumstances where maybe a single member LLC does make sense. I've not seen one where it does, given the other options that are available. But doesn't mean that it wouldn't be true. A multi-member LLC is default treatment is that of a partnership. It's one individual plus another individual. It could be one individual plus another entity. You and your corporation both become managing members of an LLC. The corporation is an individual, but it's not a natural person. It's an artificial statutory person, but it's still a person. So you and your corporation form an LLC. You're both managing members. Well, that creates some unique tax opportunities. Income passed through to the partners might be taxed a little bit differently for you and that of your corporation. C corporations are not taxed like individuals or S corps. So there's some advantages and opportunities to set the structure up to complement and enhance the ability to keep more of your money. We're just playing the game, keep more of my money. How do I keep more of my money? Two-person team buying and operating ADU investment property is a very unique structure that saves you a boatload of money. Multi-member LLC, where you have an individual and a management conduit corporation. That's a different animal. Now the corporation is a management conduit. That's different. So you have a business, a management conduit, and you have a rental property, an ADU. Now you get the best of both worlds. The management conduit is also a managing member of the LLC. So now the LLC will be treated either as a partnership or we might elect to treat it as an S corp. There might be some advantages there. Management fees are paid from the LLC to the management corp. It's called income shifting because we want it to be taxed at no tax or very little tax. So you can take that money from the management company and give yourself an accountable reimbursement plan for an auto expense, and that's not taxable income, but you get the deduction. There's a whole lot of stuff you can do once you have the structure set up. It reduces the taxable impact. And even if you have to pay the tax at the corporate rate, instead of paying 39.6 at your personal rate, you're paying 21%. Well, I just cut your tax bill almost in half just doing one thing different. An LLC that elects to be taxed as a corp and then makes the S election. The active ADU operator has a net income of $75,000. We set the structure up. A single or multi-line files the 2553. The tax outcome is that this avoids the self-employment tax or the distribution portion of the profit and allows this pass-through to get some favorable tax treatment that gives you a much better tax outcome. LLC with a trust as a managing member. Let's say you have a family trust. Well, maybe we want the family trust to be the managing member. Maybe we want to do some other things for estate planning. So, you've accumulated a $20 million estate and you want to pass that on and you don't want to have any of it subject to any tax or whatever. There's some things that would make sense for long-term planning or legacy planning that would give us some additional opportunities to do planning. At this level, you need an attorney because it's a little bit more sophisticated than what we're allowed to do. But we've got tax attorneys that you can talk to that won't charge you for a consultation to at least figure out if this makes sense for you. So we've got these 6 different characters. We put them in a little chart here. We give you the structure. We tell you the liability, the tax efficiency, any payroll benefits. Some of them don't apply. The control split, how that works. And then if the entity structure is going to be a target for potential legacy planning. It's going to be limited for multi-member. It's going to be optional for LLC plus management conduit, moderate for LLC taxes and S Corp. As a trust member, it's going to be highly advantageous at some point in the future to consider doing that. So this is all under the umbrella of an ADU pro forma analysis. How is the ADU going to perform under all of these conditions? If I did these things, what would that performance look like? What benefit would it give me? We can actually tell you, plus or minus, I think probably $100, we could tell you exactly the amount of tax that it's going to save you to the penny. The MCC structure is basically a C or S Corp, and it's going to provide management services under operations to an LLC that owns or manages or controls an ADU. The typical management fee is 10 to 30% of the gross rent. That gets shifted, income shift, to the corporation from the LLC, so you get a deduction, but you have 30% that came in as a management fee. But now you can do some other things. You can pay for your health insurance. You can pay for your office in home, your car allowance, meal, travel, entertainment. There's a whole host of things that now the corporation can reimburse you for and get those deductions. And under an accountable reimbursement plan, those are not going to be taxable income. It allows also to create active income shields, like I just explained, and pull W-2 salary from the corporation. Maybe we give you a small paycheck that's going to be deductible, but maybe in that paycheck we get some other kinds of employee benefits. Wealthy people are wealthy because they hire people like me to set up plans like this to keep more of their money. That's why they're wealthy. Here's a chart on the different structures and what they look like. It's kind of a useful organizational chart structure. I've given you the 5 most prominent. There's probably 2 or 3 more that would be secondary to these, depending on your investment appetite, how many other investment properties you have, rental properties, and how many ADUs you're planning on building out or having. ADUs are going to be one of the best performing asset groups in real estate that I think I've ever seen. It's crazy how powerful these things are. This just gives you kind of an overview of what the organizational structure would look like as an org chart for each of these entities. You take that basic structure and then you start building out from the center your tax attributes and your financial attributes to the entity level and to you as an individual level, so that we're balancing and we're making sure that we're catching all of the things in the proper order that they need to be. Otherwise, if you're not doing those things, you're losing them. If you don't claim them or you don't elect to do them, then you lose them. So this kind of helps in the process of keeping an org chart so that we know what role and responsibility each of these entities is going to play in the bigger picture of your performa. Lastly, asset classification. Got to classify the asset. Then asset segregation. Then we got to segregate the asset into segregated asset groups. And then asset grouping. Once we've grouped those assets, it's a 3-step process. You take a house on a lot with an ADU. That's an asset classification. Then we segregate the ADU as rental property, the house as primary principal residence. Then we group those into two different groups. And from the segregation, we break the house down into 27.5-year assets, 15-year assets, 7-year assets, 5-year assets. We do the same thing with the ADU, and we do the same thing with the land, raw land, and then anything except the building that's on the land is a 15-year asset. So your trees, your shrubs, your sidewalks, your driveways, your irrigation, your exterior lighting, all of those things are 15-year assets. So now they're properly classified, segregated, and grouped. And now we have some idea as to basis in tax attributes that we're going to be able to use to drive the tax planning component part of looking at all of these opportunities. These CapEx or asset segregation amounts give rise to some very complicated strategies that actually, when you get up past, I would say if you had a portfolio north of $10 million, you're going to be wanting to look at a different kind of management conduit. It's not, you'd only need one other thing, but above $10 million, you're going to want to be looking at some other things because your exposure to risk and your exposure to estate taxes and probate and other things are increasingly much greater once you start hitting $10 million of gross value. Like always, we provide a free consultation on pro forma analysis or any of these others. Basically, we want to measure 15 areas of specific financial performance, 20 areas that are specific to identify any underperformance, 20 areas of specific financial attributes, and then 20 areas of specific 20 tax attributes. The average savings or tax recovery for a person that has one ADU is about $22,000 a year. It's a pretty remarkable outcome. We just did one about 2 weeks ago for a client. I think their first year is about 80,000, and then thereafter for the following 4 years, it's going to be about 35,000 a year. What you find is that you have some opportunities to do a little bit of planning, but that little bit of planning is exponential in the benefits that it's going to be able to give you. So again, this pro forma analysis is pretty extensive and covers a wide range of different opportunities. We also, in that analysis, we do rent modeling analysis, short-term rent, short-term occupancy, long-term lease, medical use, business use. All of these things give you insight into different rent models that could be something that you might want to consider. We're covering some of these in our magazine, Taxing Times. It comes out on the first of every month. If you're a member, you're already getting that. If you're not a member, sign because it's free. We waive the $497 a year membership fee, and it's free for life. Asset models, again, we have asset models in the class life groups of 5, 7, 15, 27 and a half year. It's important because you have to track this. Always, you have to track this. This affects basis, this affects taxes, it affects everything. It affects even your insurance. Some of the report models that we have created that are AI supported, rent classification, tax optimization, all of these different reports do different things depending on the client and the client need. The most basic thing that everybody should consider is just a basic financial pro forma, because it's going to give you a little bit of everything and a lot of indication where any opportunities are at and where any weakness might exist, so we can strengthen the weakness portion. Also, in some of these report models, we extend them out and do studies. The report is a summary. It can be 40, 50 pages, but then that report, like a rent classification report, can also turn into a rent classification study. That study's probably 175, 200 pages because it's going to dial in and it's going to give you the precise kind of rent structure for your ADU based on sensitivity, proximity, demographics, a whole host of factors unique to that zip code plus 4 character. And it's going to give you a classification. And you're using that, you're not going to be one of the many ADU owners that are undercharging 25, 30% below market for your ADU. ADU is not like renting an apartment, and it's certainly not like renting a house. It's a hybrid. You want to use a different rent model because people will pay a premium for it. And then we get into the other parts of that pro forma: income, expense, equity, future gain, tax strategies, and gain mitigation. That's all part of the benefit of the pro forma analysis because it's giving you a roadmap and telling you where all the landmines are so you can avoid them. That's what the financial impact results are. Again, if you're a member, you already know this. If you're thinking about a member, it's free for life. Sign up. We just issued the July version, and I think we announced in the July version our second regional associate up in the Sacramento County. So now we have Sacramento County region, we have San Diego County region, we have 18 more regional footprints that we're going to create in California over the next couple of years, where we have a real estate professional or a mortgage professional or a tax professional heading up that county, that region, as we reach out to real estate agents and ADU owners, buyers, and sellers and expand our footprint throughout the state of California and continue to grow. It's going to be quite the ride because ADUs will probably hit that critical mass explosion mid 2027, late 2027, certainly by the first quarter of 2028. And you're going to see a very big shift in real estate activity driven by ADUs. We've got a 5-part series in the magazine also talking about these changes, the ADU revolution. May was the 1st, June was the 2nd, July is the 3rd. So we've got all the editions, the previous editions. It's a comprehensive editorial, if you will, and research that I've been working on for a couple of years that talks about the revolution of the ADU and the demographic imposition that we're going to be seeing from the baby boomers. Baby boomers are sitting on between 85 to 105 trillion dollars of wealth. About almost 50% of that is in real estate. Baby boomers are not going to nursing homes, so we have 80,000 nursing homes nationwide that are functionally obsolete. So what are baby boomers going to do? Well, baby boomers own 40% of the small investment property, 1 building to 4 buildings. Baby boomers own 35% of the commercial real estate. I mean, it's a big number. It's trillions of dollars. All that wealth transfer and all that real estate transfer, and with all these appetite for tiny homes and this, that, and the other thing, ADUs as an asset group are going to forever transform the real estate industry. You won't recognize the real estate industry by 2030, maybe by 2028. Again, you can get these in the back office much less than what they sell for on Amazon. We have buyer's guide, seller's guide, owner's guide. This is a collection of a couple of years worth of work putting these guides together to give you a step-by-step process to keep more of your money. That's all I got. At the bottom of the screen, just go to aduwealthmastery.com/register. If you're not a member, that's where you go to join. It's free for life, and you get access to all of the goodies. With that, what I'm going to do is open up for any questions. I'm happy to take any questions. and we'll go from there. All right, we don't have any questions. Then I must have done a good job. John, I'm going to go ahead and put a trail on that so you can put the bumpers on it.
I have
If
one question, if it's okay.
Yeah, go ahead.
Sorry, I started typing in, but if the ADU is in process of permitting still and land hasn't been broken, at one point, is it appropriate to kind of start the consultation process or looking at the planning?
I would suggest that the sooner you do that, the better it is for you. We just did one for a client that was thinking about the ADU, and because of the results that we came back, she and her husband are changing their plan about how they're going to do that ADU because of what we were able to identify. And the reason
Mhm.
that that's important is you're probably not aware of some other things that have been going on that could affect your decision making. And your contractor, even if your contractor did know about it, he couldn't tell it to you, and your lender can't tell you. But these things are really important. The preliminary analysis is free, but I will tell you, especially if it's in California, there are significant changes that have already been put into place, and if you're in that planning process before you even break ground, that would be the time to do that because it may influence your decisions on how you do that ADU.
Got it. Okay. Thank you.
All right. All righty, dighty. Let's see. I mean, I don't think I have anything else here.
Hey, James, I had a quick question. This is Steven.
Yeah, go ahead.
So, and I know I got to go back and review because I think you covered some of this in a previous session, but so I have a detached garage, right, at one of my rental properties that the previous owner already had electrical and water and everything ran to the unit. So I basically just updated everything, right, and made it to where you could accommodate a person or two there max in there, so it's small. So outside it looks like a garage, right? We kept all the structure of a garage, but it has a side access door and it's basically like an apartment. Now, in order to take advantage of the ADU tax strategy, obviously, I mean, we did this kind of through weekends and stuff through some of my friend contractors, right? So as far as the city knows, it's still a garage, right? But I actually had my first tenant there now, and and they moved in a couple months ago. Um, but as far as making that right, if I was considering preparing for a sale in the future or something of all of our portfolio, um, I guess I would need to go somehow get that registered with the city so they're aware that that's a
Yeah, you'd want to
ADU.
have that permitted, or you'd have a cloud on title that would prevent a sale because it's not permitted. It would be a challenge. What city is the property located in?
It's in Princeton, Texas. So,
All right. So let
so
me
they have,
see if
yeah, they
I
have a limit on permits until actually that's about to expire on the 12th because it's the fastest growing city in the nation right now, and they held new construction permits for a year, but that expires on the 12th of this month. So, yeah.
well, I would talk to a local contractor or architect that's going to be familiar with those local permitting rules. But basically, whatever you can do to preserve the permitting process, you want to do that. And then you want to go through that permitting process so that you actually have that designated. Texas is one of those areas that's going to see explosive growth between now and 2030, like Arizona, Utah. Utah, there's a waiting list to even get a house that has an ADU. It's crazy. Um,
Mm.
so I would do that first, and then I would certainly look at getting an update because you're going to have a very, very, very different composition on your tax return. It's going to be, especially because of this new tax legislation.
Okay. Thank you, James. Appreciate it.
Yeah, you bet. All right, if we don't have any other questions, I had a lot of fun.